Hey everyone, welcome back to Mr. Honey Badger. Today, we're delving into one of the most notorious financial scandals in history. Subscribe and hit that notification bell. Bernard Madoff was a well-respected financier and former chairman of the Nasdaq Stock Exchange. Born in 1938, he founded Bernard L. Madoff Investment Securities LLC in 1960, which became one of the largest market maker firms on Wall Street. Madoff was known for his impressive returns and his ability to attract high-profile clients, including celebrities, charities, and institutional investors. His reputation as a financial genius made him a trusted figure in the investment community. Before we dive deeper, let's understand what a Ponzi scheme is. Named after Charles Ponzi, a notorious swindler from the early 20th century, a Ponzi scheme is an investment fraud that pays returns to earlier investors using the capital of newer investors. This creates the illusion of a profitable business, but in reality, there are no genuine earnings, just a cycle of money being shuffled around to keep the scheme afloat. The success of a Ponzi scheme relies on a continuous influx of new investments. When new investments dry up, the scheme collapses. Madoff's scheme began in the early 1990s, though some believe it started even earlier. He promised consistent, high returns regardless of market conditions, which attracted more and more investors. Madoff used his firm's legitimate market-making and proprietary trading arms to mask the fraudulent investment advisory business. He generated fake account statements showing steady gains to keep his clients unaware of the deception. The exclusivity and secrecy of Madoff's operations also played a crucial role. He often portrayed his investment opportunities as by invitation only, creating an aura of exclusivity that lured wealthy and sophisticated investors. The allure of steady returns in an unpredictable market was hard to resist. The collapse of Madoff's scheme was triggered by the financial crisis of 2008. As markets tumbled, investors sought to withdraw their funds, but Madoff could not meet the redemption requests. On 10 December 2008, Madoff confessed to his sons that the investment advisory business was a giant Ponzi scheme. His sons reported him to the authorities, and he was arrested the following day.
Bernie Madoff, 70 years old, arrested by the FBI.
The extent of the fraud was staggering. It was revealed that Madoff had defrauded investors of approximately $65 billion, making it the largest Ponzi scheme in history. Thousands of investors, including individuals, families, charities, and pension funds, were left devastated. The impact on the victims was catastrophic. Many individuals lost their entire life savings. Charitable organizations that had invested with Madoff were forced to shut down. Pension funds were decimated, leaving retirees in financial ruin. The ripple effects of the scam extended far beyond the immediate investors, affecting families, communities, and the broader financial system. One particularly heartbreaking story is that of Elie Wiesel's Foundation for Humanity, which lost millions of dollars. Wiesel, a Holocaust survivor and Nobel laureate, described Madoff's actions as evil and a crime against humanity. The foundation, which supported numerous educational and humanitarian projects, struggled to continue its work after the losses. Madoff was charged with securities fraud, wire fraud, money laundering, and several other felonies. He pleaded guilty to all charges in March 2009, and in June 2009, he was sentenced to 150 years in prison. The judge described his crimes as extraordinarily evil. Irving Picard, the court-appointed trustee, has been working tirelessly to recover and distribute the remaining assets to the victims. As of now, billions of dollars have been recovered and returned to investors, but many are still waiting for justice. The Madoff scandal prompted significant regulatory changes and reforms. The Securities and Exchange Commission (SEC) faced heavy criticism for failing to detect the fraud despite multiple warnings and complaints. This led to an overhaul of the SEC's operations, including enhanced oversight of investment advisors and increased efforts to identify and investigate suspicious activities. New regulations were introduced to improve transparency and accountability in the financial industry. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, aimed to reduce risks in the financial system and prevent future frauds. Whistleblower protections were strengthened to encourage reporting of unethical practices. The Bernard Madoff Ponzi scheme serves as a stark reminder of the importance of due diligence and skepticism in investing. Here are some key lessons we can learn. If it sounds too good to be true, it probably is. Be wary of investment opportunities that promise high, consistent returns with little or no risk. Do your research, thoroughly research investment opportunities, and seek advice from trusted financial advisors. Don't rely solely on reputation or word of mouth. Diversify your investments. Avoid putting all your money into one investment. Diversifying your portfolio can reduce risk and protect you from significant losses. Understand your investments. Make sure you understand how your investments work. If you don't understand something, ask questions or seek professional advice. Regulatory vigilance. Strong regulatory frameworks and vigilant oversight are crucial in maintaining the integrity of financial markets. Continued efforts to detect and prevent fraud are essential. The Bernie Madoff Ponzi scheme is a cautionary tale of greed, deception, and the devastating impact of financial fraud. As we reflect on this dark chapter in financial history, let's remember the importance of vigilance and integrity in our own financial decisions. Thank you for watching Mr. Honey Badger. If you found this video insightful, please like, share, and subscribe. Leave your thoughts and comments below. Let's start a conversation. Until next time, stay informed and stay vigilant.